It's great to see everybody. Thank you for joining us this morning. We'll go ahead and get started today. This is our quarterly review. It's been an exciting year so far from a 2-year follow-up. And again, we're still digging our way out of COVID, but it seems like we're mostly done with that now, unless you're one of those people that's waiting on those prescriptions that no one can get. But anyway, so we had a great turnout yesterday at our Lunch and Learn, and this is not yesterday's picture, but it's a picture of the Lunch and Learn before, and quite frankly, it's the same group of people, but they're all saying hello, we missed you, and I know a lot of you are out of town in other states and whatnot, so we don't get the chance to see you in person as much, but we certainly would love to see you if you're ever in the Atlanta area. We'll try to make a special special date to work you into this. We usually do it on Tuesdays. Yesterday, obviously, was on a Thursday, but just a few formalities here. We are a advisor with Cetera Advisor Networks, and they are not really endorsing anything I have to say. And there's some more information here. Investors cannot invest directly into indices. So I'm going to talk about a lot of indices here. I'm not allowed to talk about specific funds. I'm not allowed to talk about specific stocks. I'm not allowed to talk about cryptocurrencies, but I can talk about things in general. Some more disclosures here. We are partnered with Morningstar for, gosh, 30 years now, back when they bought up Ibbotson. So Morningstar has been a great partner to us, and we use them for a lot of our information and also for our stock picking team. More information here about the indices, and yet some more information here. So we'll be sending this out later, so you'll have a chance to read it in full if you like to. So, hey Ted, good to see you, sir. All right, so again, finally to the information we've been waiting for, which is the investment market update. And again, this is just for this year so far. The other thing is that this information ends as of April 1st. So everything that's happened between April 1st and now, which has been quite significant, is not really reported here. But we'll talk about it as much as we can. Now, if you go back and look at the S&P 500 since 2016. You can see everything was going, you have Brexit, and we have the trade wars going on here. And then we have COVID, which was obviously none of us will ever forget that, right? And then after COVID, we had a lot of stimulus, low rates, almost to zero, $7 trillion worth of stimulus and new money, which is why we've had all this massive inflation here. And then we peaked out in about January 2022, and then that year, 2022, was a really bad year for the market. And then the 2023 turned around to was a really great year. So at the end of 2023, we really had just recovered to where we were at the end of 2021. So that was a very volatile round trip. Now, since then, since the beginning of this year, the S&P has continued on that upward trend up until a couple of weeks ago, and really maybe just a week ago, in which case about half of this now has been lost. And you can see that we're fighting it even today. But all in all, that's a typical retreat, and then more stimulus, and then all of this is in the face of rising rates. So we'll have more to talk about there. Generally, as you all know, what drives our economy are corporate earnings, and corporate earnings are generally driven by consumer demand and consumer spending. And so 70% of our economy is based around consumer spending. And you can see that, well, in general, as Americans, we do a pretty good job of that. So here you can see earnings per share have increased, and that pretty much always tracks along with the stock price. Earnings per shares were still doing well, even though we had that pullback there. So we'll see more. Now, remember, earnings per share and things like that, that's a lagging indicator. So people spend money after they feel good. So if their 401k is in good shape, then they feel good about it, and they have a tendency to spend money. So you can't look at this and say, oh, things are going to be going great. They have gone well. You see there was a drop here during COVID, obviously, because we were all locked down. But for the most part, when spending is up, the market will follow that. The problem is that when people start losing jobs and people start going through layoffs and things like that, the spending can slow down, and especially if there's inflation. one of the things that we've seen, obviously, is a lot like 1998 and 1999. This has been a very high growth period. And most of this, if not all, I can't say all of it, but a lot of it has been driven by artificial intelligence and the strides that we've made there in the communications and the technology sector. So we've all heard about artificial intelligence, and some of us have more of it in our lives than others, but we all have some of it in our lives, and probably more than you would imagine. But that's certainly the wave of the future. But I want us to dial back again to 1998 and 1999 and remember that the internet was a new thing. And, we had MySpace and AOL and all those things that were coming out, not necessarily around today, but the internet is still around and is better than ever. Well, depending on how you look at that, right? Okay. So, but we can see definitely that growth has been the flavor of the last decade or so. And the difference between, for some of you who may not know that, the difference between growth and value stocks is generally what they do with their dividends. So a value stock like Southern Company, they make electricity, and it's not like they have to create, new ways to electricity. We just put another nuclear plant online out here. So, they pay dividends, and they take those dividends and they pay those out to their investors, their shareholders. Growth, on the other hand, when they have revenue or they have assets or money, they take that and they put that into research and development or expanding, going from the iPod to the iPhone to the iPad and things like that. So they're expanding, and that's to acquire more growth market share. So they tend to do differently in different times of the year and different phases also. So we can see that this year so far, the Morningstar Large Cap Index has really been the leader. And a lot of that is because, again, of the AI, is the larger corporations that have, the massive amounts of money to pursue AI, which is quite expensive. But you can see year to date so far, now this is before the end or the beginning of April, but the first 3 months of the year, you can see that the stocks have definitely been leading and the bonds have been lagging. Roughly about the same story over the last 10 years. We've had low interest rates for a lot of the last decade, and you can see that the bond aggregate has only yielded about 1.5%, 1% for the Barclays government bond funds or indices. Corporate high yields have done better, but really not nearly as much as you would expect over a longer period of time. But you can see growth has outpaced everything. Again, growth in the space of communications and technology. If we look at each one of these asset classes for the last, since 2007, this is best to worst. So like, for instance, in 2012, emerging markets were number one, then Europe, then small cap, then the S&P, then a balanced fund, which is a 60-40 fund of the S&P and fixed income. So you can kind of track and see the balanced fund is never at the top, okay, makes it 1 year, never at the top, but never at the bottom either. So that's why it's balanced. And you can see that for the most part, it ekes out a pretty good middle of the road return. One time that didn't work was in 2022, when bonds were down and stocks were down significantly. So the balanced portfolio that year would have dropped by 14.5%. But if you were paying attention, most of the bonds that dropped that year were longer term bonds, especially the ones were like 20-year treasuries, 10-year treasuries. Those dropped significantly. And I would hope, and I guess this is not true, but at least in our case, we saw that coming. We knew that interest rates were at the bottom, and we know that longer term bonds will react more dramatically to interest rate changes. And in fact, they did. And that's why we had all those banks that were failing, like Silicon Valley Bank, because they were holding a lot of longer term treasuries. And you would have thought that somebody managing billions of dollars would have known that, interest rates will crush bonds if they're longer term. So it's a mystery to me why that happened, but it did. So in our case, though, we stayed very, very short term, less than 1 year, and we really were not affected by that. Now, in reverse of that, we have to consider, well, are interest rates going to go up or are they going to go down? Now, did I just scare you because I said interest rates are going to go up? Well, There's a Fed president of New York Fed yesterday came out and said that, yeah, interest rates probably do need to go up if we can't reach our inflation target. And then a few days before that, Jamie Dimon in his shareholder report also mentioned that maybe rates should go up. So now all of a sudden we're hearing a different tune. We'll talk more about that in a second. But the sector returns, again, we break these down. You can see all of these are pretty much winners for the year so far. The S&P right there in the middle, where communications and AI and technology and all that stuff is way out in the front. And then real estate is a lagger. So that might not be residential real estate, but more commercial real estate, which we're going to talk more about in a second. But, let's look at the volatility for the year so far. Since COVID, and really since 2022, when we had that really bad year, volatility has slowed down a good bit. And again, toward the end of March, we were only pretty low at 13. But I can see today, and I can tell you from the last week or so, that this has picked up among the above the average. So this doesn't really tell us a whole lot about the future, quite frankly. This just kind of tells us that we go low for a while, and then a surprise, and then a surprise, and then a surprise. And so now we're dealing with Israel and Iran trading shots with each other. Hopefully, no one's been killed yet, and hopefully that will just sort of die down and stop and not spread into a wider issue. The global markets, you can see emerging markets, which include China still, which I don't know that China could really be considered emerging anymore when they're pretty well developed in a lot of areas. But you can see the developed world has done well this year so far, and emerging is lagging. But I think some of those emerging markets like Cambodia and Laos and Vietnam especially, and also India, I think that longer term that they're going to have a positive run as more and more industry moves out of China into these other emerging markets. If we look at gold and interest rates, they don't have a whole lot to do with them other than, when you have more money supply out there and you have more inflation, gold has sort of that memory of, oh, wow, this was the reason we hold gold, right? Well, this chart says 2,200, but I can tell you gold just hit $2,400 an ounce. So $2,400 for an ounce of gold. It's hard to fathom that because I can remember when it used to be 350, and I think I can remember when it was 275. And I know some of you probably might be able to remember when it was even cheaper than that. And I know a few of you on this call have bought some back in those days. So I think if you own it, you just want to continue to hold it because I don't see the dollar reversing in value anytime soon, nor any currency for that matter. In terms of sectors, we can see that utilities have done really well. These are dividend yields, by the way. So this is explanation of value. So remember, value stocks are the ones that give us those dividend yields, and whereas growth stocks like technology down here really don't yield any dividends. They're more focused in on creating the next breakthrough. And I can tell you the next breakthrough is quantum computing. So we're all talking about AI right now, and yes, that's very impressive, and yes, that's incredible. But the next thing I strongly believe is going to be quantum computing. And then the next big thing after that is going to be when they take quantum computing and they put AI inside of that. And already, there's an argument that AI is beyond our capabilities. And when quantum computing comes online, it will certainly be way beyond our capabilities. So as humans, so it's a definitely interesting time to live, to be alive and see what's coming down the pike. So global economic activity has been slowing. In China, that's slowed down. U.S. has slowed down. Europe has slowed down. So this is one of the things that we've been kind of keeping an eye on. And again, remember, economic activity for the most part has to do with consumption, at least in the United States for sure. And it could be said that consumption is slowing down because the general person on the street is not having an excellent experience. I hear this again and again and again, where the jobs are not paying enough to afford the rent. People are spending 70% of their income on rent. You know what food prices are like if you've ever been out to eat or if you've been to the grocery store lately. So So yeah, it's for the average person on the street, it's not very rosy. Forecasts have been generally negative, more negative this year in 2024 than they were in 2023, at least for the developed countries. Obviously, Russia's taking a hit, and then 2025, those are forecasts, but I don't know about those. Those forecasts always have a tendency to be overly optimistic. And so if we look at really what GDP is in the way we used to figure it, a group called StatosStat still follows this, a guy named John Williams. And we get this information from the Bureau of Labor and Statistics. And you can see that the red line is the official line where our GDP is more like 5%. But the alternate, which is the way we used to calculate it, has it below, has it in a negative position. And a lot of people don't realize that one of the things that they've done here is they've used government spending as an addition to GDP. But that goes directly against real economics, where if you take money out of the system, out of private individuals and private investors, and put it into the public sector, that you're going to get maybe a return, but you're going to get a diminished return. So $10 can turn into $20 in the private sector, $10 turns into $5 in the public sector. And so that's really the difference here, is the spending that the government does is considered GDP, when really that money has been robbed out of the private sector, and the situation would look reversed if our tax rate were cut by half, for instance, and our spending were cut by 65%. Good luck on that, right? So, to quote Warren Buffett, which I always do, he's talking about, you don't have to be a stratospheric IQ, or have inside information like Congress. But what you do need is an intellectual framework, that's sound, and then you need to keep your emotions from eroding that. Because one of the worst things that we find is that people get emotional, especially the fear of missing out, or maybe when the market's dropping and there's a fear that the market's going to go to zero. I can't tell you how many times I've heard that. It's going to go to zero. No, it's never going to go to zero. But it also is never going to keep going up either. And so that's the position that we're in right now. And we have some concerns about that. We have some concerns about where we are going in the future. And we're not looking at, how people feel necessarily. We're looking at leading indicators and interest rates and corporate debt, stock valuations, the unwinding of the central bank balance sheets. And then one thing that maybe a lot of people aren't even talking about yet is commercial office space, which is where we really see some issues coming down the pike. But before I jump into high interest rates, I just want to talk about leading indicators, because this doesn't get enough news as it should. And leading indicators for us are important because it kind of lets us know where we're headed. Lagging indicators for us are useless because that just tells us where we've been. And I know where we've been. I want to know where we're going. And leading indicators are these things that are kind of the first hint that something is going to happen. So for instance, they're going to build a neighborhood close to your neighborhood. And what are they going to do first before they start going out there and clearing and putting roads in? The very first thing they're going to do is file for permits, right? They're going to file for permits. That would be a leading indicator. Or they're going to put in a shopping mall. What's the first thing they're going to do? Zoning. So you're going to see zoning and then you see permits. So the zoning and the permits, or you're going to open a factory and you need a whole bunch of factory machinery. I don't know what, all kinds of things, the Bessemer process and whatnot. So, those are initial orders, initial factory orders. So those things that give us the first hint that, hey, something big is going to happen here. Those are what we call leading indicators. And year to year, we have sort of a baseline of what the leading indicators generally look like. And if they go above that, then we always have a pretty good growth expansion. And if we go below that, then we know we're in for some trouble. If it drops below 5%, then in almost every single instance, and on this chart, in every single instance since 1970, when we've dropped our leading indicators below 5%, we've had a recession. So these gray lines here are recessions. And remember, recessions are followed by market crashes or corrections, if you will. So I guess the word crash is subjective, but if the NASDAQ is down 45%, I'm going to call that a crash. But in each one of these cases, every time we've had negative indicators, we've had a recession. Here, 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 negative recession, negative recession, negative recession, negative recession, and it's negative again. So you ask yourself, what's fill in the blanks? What's next, right? Um, so interest rates obviously have been a big part of this, and in the mortgage area, interest rates are much higher than they've been really since, gosh, going all the way back to for 2000. So for 25 years, mortgage rates and interest rates are higher than they've been now for 25 years, a quarter of a century, and it's hard to believe that I can remember all of that. But that is the case. And again, we've seen where the New York Fed president just came out yesterday and said that, he's in favor of maybe a couple of rate hikes, where Jamie Dimon is saying the same thing. And I discovered that what happens is usually JP Morgan, JP Dimon, they're going to hint things first, and then maybe a couple of Fed presidents will hint the same thing. And then next thing you know, it's policy. So the New York Fed president is nothing to sneeze at. He's the second most powerful person on that board behind Jerome Powell, depending on how you look at it. And certainly the most amount of money is being flowing through the New York Fed. And then, obviously, if we look at historical interest rate cycles, what we generally have is we have rates going up. We'll sometimes have a plateau. The market will crash. Interest rates will drop, and then we have a recession. And then we do a lot of printing. We have some stimulus. Interest rates are low. Then we have inflation. Market starts doing better. Employment starts doing better. We have rate hikes, rate hikes, rate hikes, and then we plateau because market's shaky. And then the market crashes, and then we have a recession, and then we chase it all the way back down as all the way almost to zero. Okay, and then everybody is nice during here. We have a lot of stimulus, a lot of growth, market does well, then we have inflation, then we got to start raising rates. But in this case, we had COVID. Didn't see that coming, right? Out of left field somewhere. But we had a little mini recession there, but we had a massive amount of stimulus, a massive amount of creating new money. With the PPP, we created $7 trillion of new money out of nothing. And obviously, what does that do? It's going to create inflation like every time, and that's what we're living with now. So because of that, we've had to jack rates up really fast, really quickly, up to as high as they've been for 25 years. And now what are we doing? We're plateauing again. So here we go again. The next thing will be a shaky market. Have we seen a shaky market? Yes, we have. And what are they talking about now? Well, they're talking about inflation is not necessarily tamed, so we can't lower rates. But we might even have to raise rates. And so that's a whole new discussion that just occurred this week, right? Everything has been about lowering rates. And you can see that all the central banks are pretty much moving in unison here. The red is the Bank of England, and the gold there is the European Central Bank. So I just read now that the European Central Bank is expecting a rate cut in June. So we'll see how that goes, if they delay it or if it's going to be extended. Now, one reason that there's some fluctuation here is because of the differentiation in the prices of the different currencies. So recently, the dollar's been doing a little bit better against the euro. And so they want to keep all this kind of stuff in pretty much par as they can. So if anybody gets out of line a little bit, they make those adjustments. So, and more than just inflation in this country, there's also, the parity with other currencies throughout the world. We've seen where, we were told that rates were going to drop. And so where we currently are at 5.25, which is, our cycle peak, and that was our cycle peak during the 2008 period. We were supposed to drop down, to about 4, maybe 4.5, 4.6 sometime this year. But now those hopes have kind of gone out the window, and now they're even talking about raising rates. So here was the projection, and this projection was earlier this year. And each one of these individual dots is each one of the specific Fed governors and how they vote or what they project. And so you can see there's one governor up here that's really still pretty bearish. And then obviously, most of these governors here have changed their votes now. So most of them were saying, oh, in 2024, we're going to be at 4.6, but now they've changed their tune. And so it looks like for now, at least, up until maybe September. That's what we're looking at now. Maybe September, we're going to stay where we are. If a couple of them are already talking about raising rates, then I don't know how that's going to fit in with our rate cut plan for the rest of the year. So it may be that we get through the rest of the year without any rate cuts at all. But if we can get through the rest of the year without any rate hikes, that may be a win as well. So we'll just have to see when that'll be. But right now, we're expecting a rate cut in September. I personally think that will not happen. I've been right before, but I have been wrong before. It happened once in 1992. No, I'm kidding. It happens all the time. Just ask my wife. Okay, so corporate debt. This is another big problem with raising rates. So corporate debt all across the board. See the mid caps and the small caps never had this much debt, especially as a percentage of their capitalization. But if they're giving away free money, why not, right? So that's what happened. They took in a lot of free money, and now they've got all this debt. So when the debt matures, which are bonds, then most of that debt's going to be rolled over to a new series of bonds. And guess what? The interest rate is going to be much higher than what it is today. So if you're sitting back with, $100 million in bonds that you only are paying 2% on or 3% on, and then all of a sudden next month, a lot of those come due and they have to roll over, you're not going to be paying 2% anymore. You're going to be paying 6 or even more, 7. So this is going to cut directly into everybody's earnings. And remember how that works? Earnings and price go together. So the higher the earnings, the higher the price. The lower the earnings, the lower the price. Now, pre-1991, the average PE ratio was about 14. So if you got above that, you were in danger of losing, your stock price dropping. If you're below that, well, that was a good buy. And now that's kind of moved up to above 20. I personally have always liked the rule of thumb of 20. So a PE of 20 makes sense to me. Anything above that, I really have to think about it. Anything below that is probably a good buy, depending on other things like debt and whatnot. So you can see our PE is closer to 34 today. Today it's probably closer to 30, but it's above the average. And in fact, if we look at the general trends, historical valuations of the S&P 500, and we look at it in every single category that we measure it: price to earnings, price to book, price to sales, price to cash flow, and dividend yield. Inside those boxes, that's the historical range, and that's where generally prices will fit within these categories. You can see the red dots here. Those were the prices, and those were the valuations last year at this time. The blue dots are the valuations as of this year at this time, which is March 26, 2024 was the last data point. So valuations are above, where they should be. The price earnings, price to sales, price to book, price to cash flow, every single thing across the board. Then you throw in the forward valuations on things like that, and the forward-looking variables that are coming down, and it's scary. Add into that also that the balance sheets of each one of these central banks are now in reduction purposes. So what does that mean? Okay, in a period like where we had COVID, so the Treasury needs a lot of money. We don't have the money. So we have to go to the Fed and say, hey, Fed, we need a bunch of money. So what they do is they print all that money. They just create it out of nothing electronically and send it over to the Treasury. And then the Treasury sends that out in PPP and Social Security and all of these different programs. And the Pentagon gets a whole lot, and Medicare gets a lot, and Medicaid, and all those things, but especially, the PPP program and all those other things that we were, all the stimulus. So all that went right out into the economy, and that created inflation. That's why we have inflation, because we added an additional $7 trillion. Well, as those bonds mature, the Fed has decided they're going to let those roll off the balance sheet. So they're not going to renew that money. So as that money was created electronically, as these bonds mature, that money is being destroyed electronically in the same way. Well, we know through history that when you get into a period of monetary destruction, a monetary contraction, as we call it, there eventually will reach a point where you have a credit event, where things lock up, where there's more demand for money currently than there is supply, and then there's not enough demand, or there's not enough supply to cover the demand, and then we have a credit crunch, and that just creates sort of a drop along the way. And usually that starts in the banks. Sometimes it'll start with one of our trading partners, and then we'll migrate here, and then it'll make its way around the world. So the one thing we learned from COVID is the world is very, very interconnected. And you can see that all these central banks are, except for the Bank of Japan, the European Central Bank and the Fed are both reducing their balance sheet. So those are two big players on the scene. Uh, and China, has already been is already experiencing really a recession right now that really no one's talking about much. But the problem that we see coming down the pike, honestly, more than anything, is this commercial real estate. So, I mean, just yesterday, there was an article that came out, Blake sent me, um, and it was about commercial real estate foreclosure. So just yesterday, commercial real estate foreclosures jumped 117% in March as trouble looms. So commercial real estate foreclosures, right, jumped 117% in March alone. If you take our building, for instance, um, there's not a whole lot of people here. I mean, I would say, if I had to really guess, I would say maybe 30-40% occupied. The parking deck is completely empty, and the parking lot is about half full. So, it's probably 30 to 40% occupied. But I can tell you that, most people are still paying the rent. The leases are still in place, but by the end of this year, a lot of those, I understand, are going to roll off, and they're not going to be renewed. And so already this building and our owners of this building are trying to get a variance. There's a zoning variance so they can turn this building into assisted living with like a nursing home and all of those things. So that's going to be quite an expense, but we may have to move out. We'll just move right up the road, but we may have to move out because the occupancy of this office building is too low to maintain it. And this is not just happening in this building, and it's not just happening in this city, it's happening all over the country. And it's happening in other places like California and San Francisco in a big, big way. We have friends that work with BlackRock, and they have about 8 floors of a building out in San Francisco. They're only going to renew 1 floor. So that's 7 floors that they're not going to renew. And a lot of that, has moved out here. I appreciate that. But a lot of it's not going to be renewed anywhere, because guess what? Since COVID, they've learned that, they can be still pretty productive from home. And it does cut out a lot of travel time. I could see the appeal of that. But what we're finding that more commercial leases are going to roll off the books. They're not going to be renewed, and there's going to be a lot more commercial space that's going to be empty. And we feel like that will be kind of where things start. But you just never know. What you think is going to happen is almost certainly not what's going to happen. One of the things that we kind of laugh about around here is, the misinformation that we get. Is it disinformation, or are they really just this dumb? This is the International Monetary Fund that came out in 2021 with these guys who they've never had a job where they actually had to create jobs. They just were employees told what to do. They've never had to, hire people or fire people or pay corporate taxes or, all those things that we have to deal with. But, these guys in 2021 are telling us inflation is going to be around 2.5% by the end of 22. Okay. So, oh, that's going to be just great. Everybody relax. Well, that's anything but the case. If we use the government's own numbers, the number was closer to 8%. If we use the numbers that we used to use, the formula that we used back in 1980, that was closer to only 16, 17%. So in 1980, after that, we didn't like the way this looked. So we just changed the calculation. So for instance, if someone is unemployed for more than a year, they fall off. If they have 2 jobs that are both part-time and they aren't really considered fully employed, those fall off. If they are woefully unemployed, those fall off too. So there's all these little categories of when people fall off. If they're students or anything like that, they fall off. And so, a lot of those people don't have health insurance. A lot of people don't have the 401k plans. And so, we just change the numbers if they don't look good. So they don't look good, we might need to change the formula again. Unemployment rates, the same kind of thing. They change those numbers. If we look at the unemployment rates where we used to look at them, we're closer to like 25%. So a whole quarter of of the population unemployed, the working population, not retirees, not kids and things like that, but those that are able-bodied and able to work. And you can see this when you go out to restaurants. I've been to restaurants where the entire section is closed because they don't have enough wait staff. And I don't think it's not because the jobs aren't there. It's because that you've gone through a period where the government's giving you all this free money, and then all of a sudden that stops now, and then you got to go back to work. But everything is so expensive that it's not really even possible to work enough with with the wages today to afford to just afford the basics like rent and food. So I read reports where people are spending 70% of their income just paying rent. And then if they are going to go to the grocery store, or God forbid they go out to eat, that's a whole nother expense. So, I mean, it's just typical of governments to spend money, to waste money, to inflate money away, to destroy money. It happens every time. There's never been a government in history that hasn't done it, and I don't know why we would think we would be any different. I guess just we've now hit the point where the dollar is seen its last leg. If we look at the holders of U.S. Treasuries, these are our debt. So we're at $34 trillion worth of debt. Uh, I don't know if anybody is even considering ever paying that off or how that might ever happen. But in my opinion, it's just not possible. So we're going to inflate that debt away by making sure that the dollars that these things are owed in, we owe you $100,000. Well, $100,000 used to be $100,000, but we're going to make it be $1,000 now, like, the Italians did. And then I was over there when they just decided to cut off 3 zeros from the lira. You remember the lira? So you have 150,000 lira and you can buy a lunch with that. And then they just cut off 3 zeros, and now you have 150 lira. That's much more palatable. So I think, also with the new Fed coin that's coming out, and it's going to give us a good reason to get off the dollar and then get onto this Fed coin where there really is no more cash. And in all honesty, I don't use that much cash either way, but with this new Fed coin, they're going to be able to see where every single payment that you make, they'll be able to see where that goes, who it goes to, what it was for, and they'll be able to turn it off. So for instance, if the IRS, God forbid, makes a mistake, that never happens, right? But the IRS makes a mistake. They made a mistake on my taxes. They said I didn't pay something, and I sent them a receipt. Yes, I did pay this. But let's say that they're adamant that you made a mistake and you owe them a bunch of money. They can just take it. The other problem that we're looking at, and this is not even on our board, but it's the personal savings rate among our population. Most people don't even have $1,000 for an emergency. So the personal saving rate, we were doing well there, when during the pandemic and everybody wasn't working, but we were getting free money and I guess pocketing it. But that certainly changed when everyone came out and started shopping again. So it's just too bad that those people couldn't save, especially now when interest rates are higher. You can lock in a 5% on something longer. The one thing that people talk to me about and ask me all the time is, what? It's a presidential year. Isn't this just going to change everything? Doesn't this just take all bets off the board? Doesn't this make everything that you're saying completely moot? Well, no, we've gone back and looked at it. I've studied in every single way I can, from Truman to Eisenhower. I mean, you would have thought that Eisenhower would have had good years, but Eisenhower had bad years. And I guess that's not Eisenhower's fault. That's really not Truman's fault either. It's just that, we were coming out of a war where we spent a lot of money, so we had a big boom. And then what do you have after a boom? Well, you have a bust. And it just so happened that Eisenhower was there at that time. Johnson definitely doesn't deserve his blues, and then Nixon, I guess he deserves that. But Johnson is really the one that created all the massive inflation that we had that Nixon inherited. And as much as I dislike Nixon, he took us off the gold standard in 1971. He really had no choice. He had to do that because of all the inflation that came before that. Kennedy was trying to get us out of Vietnam, and that's probably why he was shot. But Johnson came along and expanded the war, and then the military-industrial complex, which Eisenhower had warned us about, really was running the country. And I would bet you that they're still running the country, which is why we're constantly at war. Um, Carter, what can you say about Carter? Bless his heart, right? Bush won, those were negative years for him, or those were red years, but for the most part, those were pretty good years. And then under Clinton, we had some good years that really was probably seeded by Bush one because he had all those tax cuts. So that's the first time, and probably I can remember that we ever had a balanced budget, and actually we're running a surplus. But it wasn't because of Clinton; it was because of Bush one. So Bush two comes in, and he inherits that mess. And then, from there on out, it's just been crazy with all the money printing. So, the same thing with presidential parties. Does the party really matter? It doesn't really seem like maybe it has a short-term effect on the economy, but longer term, it just seems that there's good years and bad years in both. And they're both equally guilty of where we are in terms of this debt. So I'm not happy with either one of them, quite frankly. And we've seen that where the stock market and the presidencies does not seem to matter. The tip end here of Bush the second, and then Obama, and then Trump, and then Biden, and I guess there's an argument that Biden hasn't had a very good run. So FDR didn't have a very good run. So everybody loves FDR, right? So those are our major concerns. The interest rates, where there's going to the corporate debt. Those two go together quite handedly. Stock valuations are overvalued, especially when it comes into the corporate debt, right? Because interest rates are up, corporate debt is up, and that hasn't moved its way through the stock valuations. So if stock valuations are high right now, what do you think they're going to be like when the earnings are cut in half, which is very likely to happen with the debt going up? The leading indicators, we talked about that. They're just, there's been a real slowdown of planning. You still see things building. Those guys have already been funded. So all those buildings that you see going up are probably going to end up, if they complete them. Remember in 2007, 2008, a lot of things just sort of laid around uncompleted. That could happen again. Unwinding the balance sheets when we have money that's in expansion mode, stocks generally do well. When we are in contraction mode, eventually we hit a credit limit point, a credit crash, credit event as they call it, and that could very well be starting out in the commercial office space, because you can see that year over year, month over month, more and more of those leases are coming due, and they're becoming vacant. So I wanted to just give you a chance, if there's anybody that has any questions. I know I did a real thorough job there, but if you have some questions, I think if you hover down at the bottom of your screen, you'll have an opportunity to ask some questions there. But it looks like I covered everything pretty well. So for those of you, I think there's maybe only a couple of people, 2 or 3 of you, it looks like, that maybe don't know what we do. We have 3 divisions here. We have our legal team, our financial team, and our tax team, and we actually work behind the scenes to coordinate on your behalf. And not everybody chooses everything. Some people just want legal work, some people just want financial work, and some people just want tax work, and some people maybe want 2 of these, but some of them want all 3, and that really makes it easy for their beneficiaries, or even for their spouse, when they get into their 80s or their 90s and things aren't as memorable as they used to be, shall we say. All right. So I want to thank everyone. I really appreciate it. I hope I can see you next time in person, but I understand if you're like Ted Rising down in Peachtree City, or like some people out in California, or some people out in Seattle, and there's some people in New York and Maryland and Texas. Great to see all of you. I hope I can see you again soon, and I hope you all have a great spring, and have a great day, and have a great weekend. Thank you very much. Bye-bye.